Hello everyone, good morning. Thanks for joining us. My name is sobczyk. I run the quant research team here in San Francisco for Thomson Reuters for our analytics business called Electron Analytics. That includes our core offerings, so news analytics and machine-readable news. As Seth has mentioned, Rich Brown sadly couldn't make it because of the weather in New York City. So I'm going to give this talk on his behalf. I'm coming from a very, very different background than probably most of you. Essentially, I'm coming from trading and asset management space. So this ultra-secretive space, we rarely give public speeches. We rarely talk about psychology of the markets. We work, these crazy hours in front of trading terminals most of our times. But here I am, and I'm going to talk about our research, the newest project that we engage with, essentially how we use news and social media sentiment to understand the psychology of the market. And just one comment, for those of you who saw Rich Brown speaking last time on this symposium, actually our team won, in the last 6 months, won two prestigious awards. One is from the technical analyst for the best news analytics software in financial services, and the other comes from financial news as the best use of social media in trading technology. So just bringing it up. So let's start. So I think we all can agree that groups of people or crowds move markets. And these crowds are made up of individuals. Those individuals are traders, investment professionals, or retail investors who trade, invest, take risks. We also know that the decision-making of individuals is altered by variety of factors: news, information, rumor, and emotions. And I think Kate alluded it in her first talk, that there is a wealth of evidence coming from essentially academic research, from behavioral economics, that particularly emotions like joy, anger, fear, anxiety affects the investment decisions on the individuals. The key question that I'll be talking here today is, can those emotions be measured in a quantifiable fashion and used essentially as a leading indicator to essentially forecast market behavior? So here I'm providing an anecdotal example of, and this is a real life example, of a crowd behavior. Essentially, in this example, on Monday, September 8, 2008, essentially an outdated news story about United Airlines filing for bankruptcy surfaced through social media, blogs, to national news wires, and then to trading screens like at Reuters and Bloomberg. And essentially, within 5 minutes, the stock price dropped from $14 to $3.50. Crowd behavior. It recovered later during the day. This is just one trading day. It didn't recover fully. But again, totally false story can cause such a widespread panic. So where do we come from, Reuters or later Thomson Reuters? How can we help, and how can we come to this space as a 160-year-old news agency company? How do we fit in? So let me give you just a little bit of background from our perspective. So of course, Reuters is essentially an old company founded by very intelligent, ambitious, and foresighted German gentleman, Paul Julius Reuter. And essentially, the spirit of Paul Reuter stays with us to this day, and essentially is to bring these exclusive news stories as fast as possible to as many people as possible. So the spirit of the news stays with us for 160 years. But of course, the delivery and the technology changes. So actually we started in 1851 with carrier pigeons that used to bring stock prices news from Hanover to London. Well, 10 years later, we actually brought the news of the Abraham Lincoln assassination via telegraph line to Europe week before the ship actually sailed from America to Europe with actual witnesses and the news in a written form. A century later, a teleprinter in White House brought the news of Nikita Khrushchev signing the truce agreement during the height of the Cuban Missile Crisis. And then in 2000s, we have our team, machine readable news team at Thomson Reuters, that essentially delivers low latency economic data with millisecond latencies. So in a sense, we came back from the speed of flight of a pigeon to the speed of light in an electronic network. And again, when we look at the variety of the data that we deliver to our clients, we look at the economic data, like unemployment numbers on non-farm payrolls that we deliver from the Office of the National Statistics of the Department of Commerce. We deliver this data to the variety of the clients in a sub-millisecond latency. And of course, this data is highly structured, latency dependent, and of course provides a limited investment opportunity given the liquidity constraints and so on. Where we recently find the most value is essentially the unstructured data, so unstructured text, so the news, social media, but also regulatory filings, transcripts, like earnings call transcripts, and so on. These type of sources, combined with the sentiment analysis, provide an enormous amount of value, and that's what I'm going to focus on today. So just one slide for those of you who have no idea what we're doing. Still, our core proposition, Thomson Reuters Machine Readable News, is an enterprise-level software that essentially brings real-time, enterprise-grade news analytics as applied to real-time news. And essentially, we score those on an entity level using sophisticated NLP techniques to essentially assess this one-dimensional sentiment on a scale from 0 to 100%, what's the author's tone, what's the opinion expressed about particular entity in the news story. So how can we make the sentiment analysis better? Again, Kate has mentioned that. Single-dimensional sentiment, positive or negative. So we went off the path of trying to look at this problem multidimensionally. And as I mentioned, there is wealth of evidence that the emotions affect behavior. Can we quantify the emotions? Can we quantify anger, fear, joy, uncertainty in a predictable fashion? Again, this is not just an academic exercise, because what I want to argue that understanding these market emotions can be extremely profitable. And essentially, modern behavioral finance theory turns more and more into this behavioral or kind of crowd-based type of explanations of essentially boom and bust cycles in an economy. So this little nice chart, courtesy of Denver Advisors, essentially shows you how the emotion play in a kind of boom and bust cycle. So you start with optimism, you start with excitement and thrill. And that's where many, many people think, wow, this is the best time to enter the market. There is so much good press about it. It's time to invest. Well, it's typically the point of the maximum financial risk. What happens then is there is this typical bust cycle. You go through anxiety, denial, fear, up to the capitulation. That then, when you're saying, I'm done, there is enough of a bad press, everybody's quitting, and that's essentially when you cash out from your 401k in December 2008. Well, this is the potential. This is the maximum market opportunity. So you understand, if you understand the emotions, if you understand these cycles, that can be extremely profitable for any investment firm or any trader. So how do we approach the problem? So how we tackle this problem? We partnered with a firm who also presented here before, whom probably many of you know, MarketPsych. So Richard Peterson is a managing director there. So MarketPsych creates for us essentially set of sentiment or emotion-like indices based on news, like premium news, like business news coming from Reuters, third-party news, so sites like CNN or Barron's or Fortune magazine, and also social media. We typically don't include Facebook or Twitters in our analysis. We don't believe there is that much value in those sources from the pure linguistic standpoint. We need like broader text or a large amount of text to properly quantify those sentiments. But nevertheless, we combine these essentially three sources, so news, third-party news, and social media, to create indices. And how we do it, we create them on essentially on an asset class specific level. So we have 5 asset classes, and I'm going to show you later during the talk to specific example how this works. But essentially, we focus on agriculture, commodities, materials and energy, countries, domestic equities, and currencies. For those 5 asset classes, we derive certain of these psychological indices that will be very common to all those instruments. And those include traditional measures like sentiment, but also mentions of conflict, fear, optimism, trust, uncertainty, or violence. In addition to this kind of common set, we also look at the asset class specific set of keywords. And you can take a look here. If you look at the agriculture and commodities, you can look at surplus versus shortage or weather damage. If you look at materials or energy, you can look at essentially chatter related to safety accident or new exploration. If you look at countries, we have a market risk index that I'm going to talk in a bit. We have keywords or indices related to government corruption, government instability. If you look at US equities, we have keywords like innovation. So essentially, you can look at any technological stock traded on NASDAQ and look, can a level of innovation expressed in news and social media about this company explain, for example, price multiples or PE ratios and which these companies trade? The perfect example, Amazon, highly medial stock, trades at a very high PE ratio that is not really explained by fundamental valuation. Can the perceived level of innovation for that stock be the missing link, be the missing explanatory factor? And if you look at the currencies, you can look at things like carry trade, for example. So obviously, this is highly multi-dimensional sentiment analysis. And compared to this one-dimensional positivity versus negativity, of course, from the human consumption point of view, this is extremely difficult to process, even to build any form of bottom-up type of model. So I just wanted to stress with this one example where we track social unrest expressed in news and social media using our indices by country, essentially the power of visualizations. Essentially, what happens is that putting a computer-generated image or computer-generated visualization on top of qualitative or quantitative data derived from the text provides a great deal of what we call intelligence amplification, and essentially allows humans to consume this data much better and in a much broader sense. So if you think that image is worth 1,000 words, a proper visualization is worth 1 million news stories, 1,000 words each. And here is just a simple example how you can display this multidimensional sentiment by tracking social unrest keywords across the geographical spectrum. But let's look, this is all just very generic, so in the remaining few slides of my talk, I wanted to show you some more specific examples, how those indices work. So let's look at something very familiar. Probably you remember the Egyptian revolution last year. And here there are probably a few pictures or photographs taken by Reuters photo ops that probably you saw around all the major news outlets. So can we track the evolution of a revolution using our social media and news indices that we created? So let's look at this. Let's look at a couple of these keywords that I just discussed. Let's start with trust. We're going to be tracking trust as related to the Egyptian government for 2 years, starting in January 2010, going back to January 2012, so the last 2 years. And what we see that in the second half of 2010, there was a drastic decline in our index level in trust as related to the Egyptian government. I mean, is this just a statistical fluke, or can we confirm this by looking at other data? Let's overlay this with our other psychological index, which tracks anger directed towards Egyptian government. Similarly, we see a very strong, statistically significant spike in the second half of 2010. We're gonna add another index that we have, government instability, also rises in the second half of 2010. Add talk or chatter about regime change in Egypt, and you see also increase slightly later, and you're going to understand in a second what's going on here. I'm going to show you just one other keyword, is essentially mention of violence in news and social media chatter. And essentially what we see this peculiar peak, and actually if you look at the dates, it's actually correlated perfectly with this huge protest on the Tahrir Square on January 25th. Overlay this with a February 12th, the fall of the Mubarak regime, and you have a very, very compelling story. And this story, of course, can be such a graph, such a visualization, such a data, provides a very compelling story for any investor, asset manager, who essentially allocates his asset across countries, currencies, and sectors. But it's not only yours, and we know for a fact that intelligence agencies, at least in this country, for years have been tracking and monitoring this data, State Department as well, and monitoring globally social unrest, regime change, talk about government instability, can be a very, very useful tool to monitor the situation worldwide and allocate resources accordingly. So let's go back from Egypt to the home turf and look at something that is much more familiar to all of us. Let's look at S&P 500 index for the last 12 years. So from 1998 up to now. You see it here with all these ups and downs that we went through over the last decade or so. Can we understand the psychology of this apparent rises, rallies, and subsequent bust using the indices that I just described? So here I'm going to present this market risk index that I mentioned at the very beginning, which we also call babylometer. We find it as a more marketable name than the market risk index. And essentially, I'm going to show you two charts overlaid with S&P 500 index. The one chart is a very long-term average, moving average of our essentially market risk index. And this is like a 500-day moving average. Let's don't go into the specifics, but essentially what we typically see, and this is quite common actually in those data sets, that we see this broad correlation between like market level and such type of market risk index. And it's exactly as I described to you when I showed you this chart from Denver Advisors showing boom and bust. You see that the market risk index is the highest when the market is the highest, and the market risk is the lowest just after the boost. Essentially, when the market index is the lowest, that provides again this point of the highest potential return or the highest buying opportunity. Now, I don't want to go here, again, as a quant, I don't want to go here too technical to the technical analysis, so I'm going to try to explain to you building the simplest technical indicator in finance, in a very simple way. And the simplest way to build a technical indicator in quantitative finance is to look at long-term average of certain indicator and overlay it with a short-term average. So here, I'm going to show you, I'm overlaying this long-term average of the market risk indicator that we created with a short-term, like a 90-day moving average. And from the simplistic point of view, the easiest way to interpret this data is that essentially when the two indicators break each other, so if the short trend breaks the long trend and essentially undercuts it, it's typically associated with a potential sell opportunity. And conversely, when the short-term trend essentially cuts and outperforms, essentially crosses over the long-term trend, that presents a buy opportunity. So let's just overlay this on this 12 years of the history of the market in the US, and you see that this simple psychological index that we create presents, it's a very, very, very strong signal to time the market. And again, we quantify this properly using correlation, factor modeling, and even putting into actual strategy. But essentially here is, I think, the easiest way that we could explain the potential for making very sharp decisions using this type of data. Again, looking at the market, just few other examples. I want to. We not only are able to track individual, countries or individual like markets, but actually we can also look at the sectors. The chart on the above presents financial sector ETF, called with a ticker XLF. Essentially, this tracks financial services, banks, and other companies in the United States. So you see this ETF totally synced in 2008, in coincidence with the credit crisis. But let's overlay it with another psychological index that we created called Gloom. So essentially, we track all the mentions, not only of the keyword gloom, but essentially of kind of bad future outlook or any form of reference of negative future outlook in news and social media. And what happens is that it's actually quite interesting. The pattern is very clear, and we see this kind of gloom as a unidirectional indicator. When gloom declines, usually it's a leading indicator for the rally. The converse is not true, surprisingly to us. Essentially, when the gloom arises, it doesn't mean that the stocks will tank. So it's not like a bidirectional, it's more like a unidirectional factor. And you can clearly see this in the first instance just after the tech bubble in 2001. Then in mid-2000s, that was the great mortgage bubble that was just starting to growing. And then the rally just after the crash of 2009. Very related psychological keyword like fear has totally different characteristics. When we track the fear, essentially we see that when the fear rises, that's usually a leading indicator for a decline in price. And you see it just before the tech bubble, and then you see it actually as a leading indicator before 2008. So something very surprising in the data, and again, looking at the markets from a very different perspective, fear and gloom, and look at what opposite effects they carry. And just to, I have two more slides, but actually, for the sake of time, actually, to take some of the questions, actually, I'll make it this as my final slide. Essentially, you can not only look at gloom, fear, market risk, on the individual sector or market, actually by country. And here, actually, to show you that it really works, I'm showing 3 months of 2012, showing fear expressed about the economy of a few countries: U.S., Germany, France, Italy, and what do I have there? Spain. And essentially, what happened, as you all aware, there is a financial crisis in Europe, and certain countries like Spain or Italy, they run huge budget deficits, so therefore their borrowing costs are skyrocketing. So there is a lot of fear expressed about their economies. And that was particularly the case during the summer with all these bailouts and so on and so forth. And look how such simple fear index, constructing using news, third-party news, and social media, how elevated it is for countries like Spain or Italy compared to more stable economies, like, for example, Germany. So I'm going to skip the agriculture example for corn, and just to take a question and essentially just to sum up, news and social media are on the frontier of current financial research, and essentially being able to analyze and consume this data undoubtedly will have a huge impact on investment management segment and provides managers, traders, risk analysts, quants with enormous opportunities to essentially make better, faster, and sharper decisions. Thanks so much.
So the $1 million question is, I think last year they showed sort of financial results of a fund or something that basically uses this as a strategy, and how does that perform versus other strategies? And the related question is just a clarification. You said you don't use Facebook or Twitter.
Correct.
So are you using basically public news stories on media? So it's not really social media, it's public media that's publicized on the internet, or is there other sources that are more social by nature?
So let me repeat the question. So the question is, I have mentioned that we don't use, in these examples, we don't use sources like Twitter or Facebook. So what exactly, how I define it? So actually, the news sources that come into the play are kind of tiered. The first tier is the essentially premium news, so essentially business news like coming from Reuters. The second part would be called essentially internet news. Those are third-party news sources. So you can essentially scrape the text from web pages like CNN, Barron's, Fortune magazine, and so on and so forth. Now, with regard to the social media, we actually score. I think the number we quote is over 1 million of website. But essentially, Twitter and Facebook are explicitly excluded based on kind of performance on our sentiment engine. But the majority of the sites are essentially blogs, stock tweets, stock message boards. This is the bulk of what we call the social media in this case. Okay?
That partially answers my question, but to further clarify, when you gave the fear and gloom indexes that started in 1998 or something like that,
correct.
At that point, were you scraping websites, or were you using APIs from these sources? And did you use purely keyword methods back then, or were you doing statistical and adaptive machine learning to get your categories and entities correct?
Absolutely. So let me repeat the question. The question is, in two examples that I gave, like fear and gloom, I had a history going back to 1998, well before the era even of the social media. So how do we get the data? Excellent question. So part of this is a hard part, and part of this is proprietary to Thomson Reuters and MarketSite. Essentially, we began scraping this essentially as early. Admittedly, we don't have the same level of coverage throughout the years. So if we look at the buzz metrics, so the number of keywords that go into our sentiment engine, of course, they are much higher recently than in 1998. However, from the financial point of view, the traders, investment managers are obsessed with backtesting the data as long as possible. So even lower coverage is very important for those type of market participants. The second part of your question was specific of the sentiment engine that we're using. And essentially, again, that's a hard part, and that's largely proprietary. If you're really interested, we can take this offline while not being filmed, for example. But nevertheless, these approaches typically are not keyword-based. Essentially, all these approaches are essentially natural language processing based. Some of them differ. Our core proposition, machine readable news, is more type of machine learner type of approach, whereas the psychological indices have a much higher degree of human curation and input while constructing those indices, undoubtedly. And I can explain more if you're interested in the break. Last question.
Yep. Thanks. The question I have is really more around the ability to establish causality and to be able to do prediction. So one example obviously is the relationship between an inverted yield curve and a recession. And there is some causality to that. It is predicted the last 8 recessions. However, the example that you gave of Tahrir Square and Egypt, the thing that intrigues me is the causal event was a fruit seller in Tunisia, Mohammed Bouazizi, committing suicide and immolating himself. You did not mention that in your tracker. So, and that was a black swan event. That happened and it unleashed the Arab Spring. Have you done similar analysis on the green movement in Iran in 2009? And have you done some similar analysis to see why that did not trigger the Iranian government? My basic question is, ex post, looking back, it's easy to identify correlations, but to be able to establish causality, as in the case of the inverted yield curve, and to be able to make predictions, how far have you gone with that?
Actually, excellent question. So let me just try to summarize it for the audience, and I hope I'll do it right. But essentially, I think the question, what you're questioning is that essentially I presented what we called a cherry-pick examples that we know that something that happened, that it was drastic, like Tahrir Square protest, and then we show, it worked. Does it work out of sample, and can we provide it, in a quantifiable fashion? Of course, again, the talk that we crafted here was created more for a broadened audience. Again, we didn't want to divulge into how we define actual factor model studies that we track that. Again, I can answer, and you have to take my word for granted that yes, we did this type of correlation studies. They are they're actually quite difficult to present because there are all other factors. And in a most proper sense, how we test it, just as a general comment, we typically put those signals into the framework of multi-factor model, where we have essentially, it's a regression-based technique, where you have a certain base of a common explanatory variables. And those are, some standard market factors like market momentum, value effects, size effects. And then in each of these cases, we try to see if adding of additional variable cross-sectionally brings the new information. So we did those tests, and on a statistical test, they are significant. And I could show you some papers offline. Okay? Thank you very much.